Hi, and welcome to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson from OTG Capital. We broadcast locally on Radio Northern Beaches and around Australia on the Community Radio Network. I'm really pleased to welcome back to the microphone Andrew Inwood, CEO of Coredata. Welcome back, Andrew.
Thanks so much for having me, Ray. It's always a pleasure.
Now, I've got to say, look, I love statistics, and the topic of our last chat was lies, damn lies, and statistics. And I guess you can turn numbers and figures and data points into pretty much any kind of narrative. And I guess, ladies and gents, one of the reasons why I asked Andrew onto our show, I had the pleasure of listening to Andrew present at a conference last year in December in Canberra. And put together, I guess, a number of data points that we were talking at that time, Andrew, if you remember, about intergenerational wealth transfer. And I think this is going to become such a huge topic because I was meeting just earlier today with a good friend of mine who runs a fairly large financial planning practice. And, you know, he's talking about how many clients are now coming in with big swatches of money. And I think it's really good that the last time we caught up, you did a lunchtime presentation and it was called Searching for Alpha. So, and that's the topic of today. So I guess the great way to kick off is to maybe explain to the listeners what the difference between looking for alpha, what is alpha, and what is beta, I guess, if that's an equally important question.
Yeah, so it's a really important question, Ray. And the quote you're referring to today is from Benjamin Disraeli, who was a great Prime Minister of England, if your listeners are familiar with him. And he's got two of my favourite sayings, which is there are lies, damned lies, and statistics. And what he was referring to is the way in which the Parliament was being misled. His other favourite quote of mine is, my other favourite quote of his is that I don't know the key to success, but the key to failure is trying to please everybody. Inside a signal, which is a piece of information coming from something which is regularly occurring, like the pattern of the stock market, you get two pieces of what are called noise. Alpha, which is the top end performance of everything, and beta, which is the kind of heartbeat and rhythm of a signal of noise. There are probably better statisticians out there who might explain that is better than me, but literally alpha is you're looking for areas where there will be outperformance in a market. So one of the things that happens inside markets and market constructs is there's two kind of thoughts that people work on. One is that you simply can't outperform the market, that the market's absolutely efficient and that it will price itself efficiently given any piece of information. And so what you should be doing is simply participating in the market. Then there are people who think that you can outperform the market, that you can find areas outperformance or mispricings, which are usually to do with time or imperfect information or those types of things. The most famous story about this is to do with the Rothschild family. And I'm sure many of your listeners will know this story, and it was to do with the Battle of Waterloo. The Rothschilds gambled on the outcome of Waterloo because at the time the British government, that most people thought the British government were going to collapse and that they would lose the war in France and that Napoleon would be successful and that the government coffers would fail. So what had happened to sort of fund Wellington, who was fighting in the Battle of Waterloo against Napoleon Bonaparte, the British sold a lot of bonds, which are government debts, and they were, as the battle was unfolding, the bonds became worthless, and the Rothschild family stood in the market and bought them up for cents or pennies in the pound, right? They were just standing in the market buying, because not only had they funded a lot of the battle, they had paid for the Germans to turn up on the second day, the Austrian Greys. And so they had also set up a private courier network, which was ships like 3 miles apart on the channel, which were to raise a yellow flag if the Germans were successful and a red flag if the Germans weren't successful. So not only did they predetermine the outcome of the Battle of Waterloo for paying for the Austrian Greys to turn up on the second day. And you can imagine that if you're Napoleon, right? You've got the English penned in, you've got the cavalry ready to charge, and it's kind of even money. Then at the lunchtime of the second day, 10,000 men appeared on the horizon. It's like, I think we're done here, boys. And and that was a bad outcome. And then the Rothschilds got the information early because they had their own private courier network and they just stood in the market. So they were seeking alpha with imperfect information. People are trying to do that now all the time. There's a thing called high-speed trading where people are trying to get 11 milliseconds in front of each of the trades, all those types of things. Then there's kind of macro alpha where people think, well, maybe property is being oversold at the moment. So now is the time to buy into property. So they're betting on the interest rate cycle. Or maybe they think that there is a new type of generative AI coming. So they're betting on those cycles. So that's how people seek alpha. It's at the best possible description of this kind of qualified gambling where they think they have more information than the market. And the other one is kind of maybe it's ego-driven trading. So where people think that they're smarter than that. The evidence around it is really choppy. Getting macro trends right is really important, but people work very hard on that, and I work on that kind of globally. But it's the evidence on it's slim, and I think you've probably got something to say about that, Ray. I know that you have some opinions on that outcome.
Look, I guess one of the things, because I'm a bonds guy, okay, so I guess when I look at equities, and I used to be a day trader back just before, as the GFC hit, and so here I was shorting the market at the time and making a lot of cash, but I had no fingernails left at the end of it as well, mind you. No, my married life was being questioned at that point, but I guess I have a preference for steady as she goes kind of investing, and that's what and again, my shameless plug is that's what my fund is all about. And so I look at, I guess, the proponents of the long haul, and I recently had Kat McPhee from Aware Super on the show, and she's talking about long-term returns. And so that's, I guess, the message that I try and give to a lot of people, rather than trying to, I guess, catch a wave. And I guess looking for alpha tends to have that kind of more short-termism, but that's not what really you were talking about at the presentation. Certainly the slide deck that I got that came through really talks about a longer play than just around the corner, doesn't it?
Yeah, so there's two types of alpha, and that's a really good call out, right? And there's day traders who are looking for mispricings really rapidly. And then there's kind of longer cycle alpha in terms of what's going on. That's really driven by demographic changes or institutional changes and those types of things. And the presentation that we were looking at the other day was really looking for alpha on what we would call capital mispricing. And the one that's most interesting at the moment is the way in which property is being treated, particularly commercial property in CBD areas and retail property and industrial property. Now, property is not property, as you would know, right? I mean, the industrial property cycle is kind of peaking at the moment, and understanding that is really important. How delivery is going to work, how people are going to consume, and those types of things is becoming really important. Things which are probably being oversold at the moment, and I'm no expert on this, and you shouldn't take it as advice, is commercial property, which is office property. Australia is slower than the rest of the world back to work. Already Western Europe, America, and increasingly in the UK, people are back to work. So the mispricing of property in those spaces is kind of over, and that's coming back in Australia. It's going to take some time, but that's working its way through. There is quite a lot of data that all good tier one property in Australia is now in massive undersupply. And that's going to be felt really badly in the next 2 years. But the tier two property, which is your B, C's, and D's places, is in oversupply. So getting that right is really important. So one of the things that Coredata that does globally is looking for those macro trends and trying to understand what they mean and how people are going to participate in it. So there's a couple of areas that are kind of running hot in Australia at the moment. One that you would know about and that you might want to talk about in more detail is the private credit market. People are finding private debt. That's running really hot. I mean, you would have an opinion on that, and I don't want to venture into that. As people are seeking super normal cash returns, as most of your listeners would know, kind of 5% out of cash is pretty good at the moment, but people are looking for better than that. And that, with all of that, comes with a risk. And I think that we should always be really careful about saying there's two types of risk. One is you can take market risk, and that's okay because the market goes up and it goes down, and it generally is efficient. And then there is specific stock risk and sector risk, and taking that on requires education, requires confidence around what you're doing, and it requires those types of things. But it's not for everybody.
I guess that's really the point, that I think when people are looking for, and I guess given what you and I do, I think the big message, and we recently had one of your crypto researchers on the show as well, Anna Venonen, and again, I comment primarily on people that are looking for shortcuts to greatness. And so when you have a discussion about looking for alpha, it'll immediately pique the antenna of people that are going, great, I can make money faster than if I was plowing the normal way. And I guess my constant message, and having Aware Super on recently, where I tend to try and talk about the midterm and long-term game, I then try and look for simplicity as well, because you rightly point out, it takes a finessed mind, I think, to understand the equities market, to understand investing in this sphere. And it takes a lot of time and education, I think, to be able to pick good winners. And part of the discussion that I want to draw upon, I guess, in the second part of the interview today, after we go for a break, is an active management perspective compared to passive. So before we go to the break, maybe you can explain to the listeners quickly what the difference between active and passive is.
Yeah, absolutely. Look, I'm a passive investor, which means I tend to invest in markets for the long term. I have a really global view on what I'm doing. The conversation I have with my wife is that all of our portfolios should be designed as if we're sitting on the beach in Fiji, and that where we were in the world is irrelevant to us. Big trap in Australia is we tend to overinvest in Australian shares because we think that they're somehow more important. Of course, Australian shares are a tiny part of the world market. We should be thinking about that in a global standpoint, above and other areas. Unless then you can be active, and active means that you are investing in what you see as short-term trends, and you trade in and out of those. So for example, you might think that there's going to be a repricing of bank stocks, so you're going to put some money into the bank stocks, and you think the people who are going to win most out of the AI boom in Australia in bank stocks is going to be the Commonwealth Bank, because they spend $2 billion a year on AI, and they're going to be the leaders in that. So you would start buying bank stocks, and then you would be tending towards CBA in that space. Or you might think that there is going to be a lithium boom, or you might think that there is going to be a boom in iron ore because iron ore batteries are going to race ahead. So people will start trading on what they see as kind of short-term mispricings in those marketplaces. And they can either be slightly longer term in that we think that bank stocks are going to perform, or much shorter term in the way in which other things work. So I have a great friend, and he's a good investor. He trades on negative headlines. Every time there is a negative headline about a stock, he waits for the stock to go down, then he buys it at what he thinks is the bottom, and then he waits for it to reprice itself as everyone works out that that's not really going to happen. He goes really well. I just don't have the engagement for it, and I can't be involved in the market.
Likewise. Well, look, we're just about halfway now during our interview. So you're here on Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson. I'm here with Andrew Inwood from Coredata. We're going to take a short break and be back with you in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money, and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments, and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation, or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels, or email. Please search for Dollars and Making Sense in your favourite podcast platform, or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson, and with me at Andrew, CEO of Coredata, a global research company. And I guess I really love picking the brains of really, really smart people, because it makes me feel smarter, I got to say. So when I rub, I'm hoping the brain cells sort of rub off on me. And today we are talking about looking for alpha. And again, if you didn't pick up the first half of the show, looking for alpha is all about trying to get extra performance in your investors. So if you in your investment, so if you are doing beta, that's run of the mill, but alpha is a cut above. And so one of the things that we talked about before we went to the break, Andrew, is that during your presentation, you were talking about the differences between active and passive management. And you also suggested in your data, the research is now suggesting that many people, certainly the top end of the marketplace, the high net worth and the uber high net worth, that I love seeing that UHW, they're now starting to look to rebalance. So what's that data telling you? You know, what are the rich people doing out there right now in the search for alpha?
Yeah, so one of the things that we do, Ray, and I'm happy to share with you on quarter, is look at how people with more than $5 million invested in the market are behaving. They tend to lead the market, partly because they're more involved in the market and partly because they're more confident around their investing behavior. And we can see a couple of interesting separations. Not much changes between 1 and 5 million. Then there's another flexion at about 5 million to 10 million. And then there's another flexion above 10 million in terms of the risk people take and the way they act. The first clue is that at the moment is that they are now risk on, which means they're getting involved in assets where they think there is going to be greater performance. Partly that's because they've built up a lot of cash. They've got a lot of cash sitting on the sideline and they're trying to put that cash to work. And partly they think that there is likely going to be a return to government in the USA of Donald Trump. And Donald Trump is committed to continuing the government debt cycle in the USA, which means that they will continue to fund growth, which means that they will print money to drive the markets to grow even more continuously, certainly through the next 4 years. And they want to participate in that. The world is having a lot of elections at the moment. There is a lot of other economic uncertainty, but the swing to the right that was feared in Europe and the massive swing to the left, which was feared in the UK, haven't eventuated. And there is a steadiness around the markets now that's starting to lead the high net worth and ultra high net worth to think that we are still a growth opportunity as a globe. And they're picking the eyes out of that sector. And the three big sectors they're picking the eyes out are computers and tech as the AI moves forward. And they're looking for AI adjacent businesses. Who's going to profit most from that? Is it going to be the transport schemes? Is it going to be the service schemes? Healthcare is a really big one that people are pushing into. That's because there is a global tsunami of aging people. And people tend to invest to keep themselves alive. I mean, it costs about $8,000 to $14,000 for every heart operation, but no one says no to that price when they're saying we can fix your heart and we can go on those. And there's going to be a lot of people alive for a lot older in that space. And they're kind of and then energy is the other one, where energy is being kind of globally mispriced because the transition from fossil fuels to renewables hasn't been going as smoothly as everyone wanted. So those fossil fuel providers are going up pretty rapidly, and that'll be replaced by the other ones as time marches on. But those are the three big trends that are really merging on. The other one is that as the banking sector gets worried about debt, the private debt, and we talked about that briefly, is starting to replace the bank as the lender in the marketplaces, and they're doing pretty well. Good managers of that are going to be really interesting.
I've got to certainly say from the private credit, and we talked a lot about alternative aspects, what are alternatives, and we'll get to that in just a moment. But because I operate in that space, it's a subject near and dear to my heart. But given the fact that we were actually going to record this interview a couple of weeks ago, but you were delayed because you were traveling abroad in the Philippines at the time and you got back. But something quite momentous happened between then and now. A candidate in the US almost died, and then the other one bowed out. So I'm just curious, as a research organization, is that going to require you to now recast some of your numbers and your thinking, given that the HNWs and the UHNWs, the high net worths and the ultra high net worths, were figuring a Trump victory, but that may or may not necessarily be quite as sure as they may have thought?
That's certainly true. There's better data out than I can provide, but Kamala Harris is a much more fierce opponent for Trump than Joe Biden was. The victory against Biden was pretty assured and pretty sleepy, but she's a very different kettle of fish. First, she's of Asian, Indian and Jamaican background. She's a prosecutor. So she's a strong lawyer. I don't think Trump will debate her, but and I think she will do a much better job than Joe Biden with. But the polls and the betting, and the betting money is always the money to follow, is still very much with Trump. That may soften, but then again, she would also be a strong growth leader. She's raised a lot of money, and a lot of money from interesting places to run the campaign. So I don't think either of those things is necessarily a bad outcome for the US economy. And I doubt significantly that she would abandon the kind of post-monetarist view of the world, which is raising money from Americans to push the economy along. I doubt that she'd be an austerity president in the way in which maybe the Conservatives were in the UK. I think that might have been abandoned now from post-monetarist governments.
Well, one thing's for sure, it's roughly 100 days to go, and I keep saying to people, get the popcorn. It's going to be fascinating to watch. I'm certainly not hedging one way or the other. I mean, I have my own personal beliefs, but I'm certainly not going to air them today or anytime soon. I want to move on a little bit now. When you were talking before the break about people looking at rebalancing, in Australia, and you rightly point out, we are a little myopic, I guess, in the way that we approach investing. Does rebalancing here locally mean that instead of having three banks, 2 banks, I'm going to have 3 banks in my portfolio, and instead of having 3 mining companies, I'm going to have 4? I look at people going, of course I'm diversified. I've got 4 out of the 5 top stocks in my portfolio. They really don't have an idea. Do you see maybe that's going to broaden? We're going to broaden our horizons a little.
Well, there's a challenging part about this, right? Because it's very clear that those Australians who have advice and advisors have much better balanced and rebalanced portfolios than people who are doing it themselves. We all get stuck in our beliefs when we're buying stocks and investing for ourselves, and that's a challenge. Advisors tend to rebalance more actively and rebalance more towards macro trends really quickly, and they do that intelligently. Other people get stuck inside the system. It's not perfectly true of advisors. Of course, there's advisors with biases as well, but we're seeing more and more the advice industry being able to professionally rebalance and professionally model portfolios which are designed for the person, the stage of life, their risk appetite and their intentions, whether they're after growth, whether they're after security, whether they're after income, and the way in which they're doing that. Obviously, we watch this around the world. We are still in Australia pretty slow to rebalance. The Europeans and the Americans are very, very active rebalancers, and they rebalance kind of on a monthly basis. And there's criticism of that too. People might suggest it's making income through churning, but you have to stay on top of the macro trends and understanding what's going on. And I'll give you a good example of that. Well, I have an advisor. He retired recently, so I'm now in the process of choosing a new one. When Russia invaded the Ukraine, I rang up the advisor and said, so how are we rebalancing the portfolio? And he said, well, we're not. We're keeping it the same. And I said, but the world's changed, right? The Russians have invaded the Ukraine, and that's going to change the world. And I got a note almost the same day from my advisor in the UK. We're fortunate or lucky enough to have a business overseas, so I tend to be able to store a bit of money over there, saying, hey, Russia's invaded Ukraine. That means we think carbohydrate prices are going to rise. We think gas prices are going to rise. We think all these things are going to. So we're rebalancing their portfolio to take advantage of that. And
they were right.
They were well right. And they massively outperformed the Australian guy. And I sent in both portfolios and said, it feels to me like we're a little bit myopic in Australia in thinking about what the world is doing. So that challenge is really kind of interesting. And also, one of the things that we all missed is that repriced credit, because banks started to reserve higher amounts of capital and they didn't lend as much, and that changed the world and it allowed that private credit market to accelerate. So the rebalancing part is really an interesting thing, and it must be a persistent challenge for you, making sure that you get that right and making sure you're on top.
Oh, look, as a fund manager myself, when we're talking about private debt and the participation in that space, I used to do business with a fellow I was in the forces with, and it's 24 years ago, and we've just stopped doing business just recently. And when he was doing his private lending business back in the day, and I'm talking early 2000s, there would have been about maybe 2 or 3. I can count well over 50, 70, 80 or 100 plus that just keep happening. And every day I wake and find there's another company that has now come into private debt. And so there's no lack of choice. I think now it's a case of buyer beware, caveat emptor, that because there are so many players out there, not all things are the same. And so, you know, I tend to say to people, be careful, you know, just because somebody's offering you a really good fixed income rate, you know, you need to understand, read the documentation. And I still get a little bit concerned that when people are looking at alternative investments, they're not truly understanding what they're getting into.
Well, there's a simple heuristic on that, Ray, and I know that you know it, but it might be useful to your listeners, that every percentage point being paid above the inflation rate is a risk-based return. And that understanding that is that you have to understand how much risk you're willing to take. Let's say inflation is at 4% and someone's paying you 6%, then there's 50% risk on that. So just making sure you understand that's important.
Yeah, and I guess one of the key things I want to wrap up and finish up, because we're just about out of time. When I was talking to one of your other researchers on the show about crypto, Anna was really complimenting, I guess, one of the key data points that she detected in people looking at alternatives and I guess trendy investments is there's a cockiness there that she didn't see in other investors. Do you see the same thing?
The cockiness is a really interesting part about it. The kind of overconfidence, and I won't get too much into it because it sounds kind of combative, is particularly young male investors. I mean, their behavior is interesting. And a lot of kind of the growth in the world relies on young men to drive things forward unrealistically, but also that's a lot of the risk as well. So the confidence that you can outthink the market is not something I've ever had, but it is, I do see it in some of my friends and some of the people I work with, and it does lead to mispricing and opportunity in the market. Look, I'm not going to go into it, but I'm pro advice and advisors, because advisors take people from chaos into order into habit into rhythm, and rhythm into sort of better outcomes.
Great message.
One of the things that my advisor does is he stops me doing stupid things, because I say, "What about this?" And he goes, "Yeah, we won't be doing that, mate." That's relatively useful. But a few years ago, I turned up to my advisor and said, "I need a new car. This car's done. I've had it for 15 years." And then he said, "Things are going pretty well for you. You've saved pretty well. Within tolerances, get whatever you want." And I found that given that opportunity, I didn't buy something stupid. I just bought myself a Golf, a manual, and that's perfectly fine.
You're happy?
I'm completely happy. But I mean, it was, he looked me dead in the eye and said, "Get whatever you want." I was like, "Well, okay, I'll take that message. I'll buy something sensible."
So look, we're just about out of time. Andrew Inwood, CEO of Coredata. It's an absolute pleasure having you on the show. I've got to have you back because there's always something that we want to talk about in statistics. And Andrew Inwood from Coredata, thank you kindly for being on Dollars and Cents.
Always a pleasure, Ray. It's a great time.